Hello, investors, and welcome back to Main Street to Wall Street. Today's video dives deep into a crisis looming larger than many realize: the soaring US national debt and what it means for you directly. The title says it all: how US debt could affect your life. And of Safe Haven. This isn't just a financial headline. It's a story about global power, currency stability, inflation, and your wallet. So, let's unpack it carefully, because what looks like complex economics can become very personal. Understanding the US national debt. What is it, really? Imagine you have a credit card with a limit, and over many years you've been using it more than you earn, borrowing to pay earlier bills and daily expenses. The US government's national debt is somewhat like that, but on a gigantic scale. As of October 2025, the US debt reached an eye-watering $38 trillion, surpassing the entire country's annual economic output, or GDP, which is about $30 trillion. This debt accumulates because the government spends more than it collects in taxes and fees. The difference is borrowed by issuing treasury securities, bonds issued to investors domestically and globally. The US debt is divided mainly into public debt, money the government owes external investors, individuals, corporations, and foreign nations. Intragovernmental holdings, debt the government owes to itself, mainly from Social Security and other trust funds. What makes this especially important is that this debt backs the US dollar's role as the world's reserve currency, the currency most countries hold in their central banks and use for international trade and finance. Why is debt growth so rapid? The debt didn't reach $38 trillion overnight. Several factors drove its dramatic rise. Pandemic response. Massive stimulus spending in response to COVID-19 to support households, businesses, and healthcare. Tax cuts. Substantial fiscal stimulus through tax reductions over recent years lowered government revenue. Entitlement spending. As the population ages, spending on Social Security and Medicare grows rapidly. Defense spending. The United States maintains one of the largest military budgets in the world. Rising interest costs. The faster the debt grows, the more interest the US government must pay. Since 2021, interest expenses doubled and now surpass education and transportation combined. Every single day in 2025, the US adds roughly $25 billion in new debt, on top of paying existing obligations. Debt to GDP ratio. A key warning signal. Economists closely watch the debt to GDP ratio because it measures economic output relative to debt obligations, indicating sustainability. As of 2025, the US ratio is about 123%, and the IMF projects it soaring to 143.4% by 2035. To grasp the gravity, Italy and Greece, European nations long cited as cautionary fiscal tales, have debt to GDP ratios around 137% and 130%, respectively. The US surpassing these marks is unprecedented in 100 years, showing a shift in global fiscal balance. Why does this matter? A high and rising debt to GDP ratio limits the government's fiscal flexibility, increasing vulnerability to economic shocks, like recessions or geopolitical crises, and raising risks of higher borrowing costs or credit downgrades. The dollar's safe haven status. Are we at the end? For decades, the US dollar and treasury bonds have been the cornerstone of global finance, prized for safety and liquidity. When markets panic, investors flock to US assets. However, recent developments challenge this status. Political deadlock inhibits effective debt control reforms. The US credit rating has been downgraded by major agencies due to unsustainable fiscal trends. Interest on debt now consumes an increasing share of government revenue. The widening budget deficit remains above 7% of GDP, the highest among major economies. The combination risks eroding global trust in the dollar and US securities. Already, alternative safe havens like gold and stable currencies such as the Swiss franc and Japanese yen are seeing increased demand. Gold prices in 2025 surged over 50%, reflecting growing investor unease. How does this affect you, the investor, in your everyday life? So, investors, what should you be watching out for? Here are the main ways the debt crisis can ripple into your finances. Higher borrowing costs. Government borrowing costs influence the interest rates you pay on mortgages, car loans, and credit cards. As Treasury yields rise due to risk premiums, banks may raise rates, directly impacting your monthly expenses. Inflationary pressure. A weakening dollar makes imports more expensive. This means you could pay more for gas, groceries, electronics, and practically everything imported. Inflation effectively reduces your purchasing power. Potential tax increases or cuts in benefits. The government will have less fiscal space to cover rising interest payments and keep essential services running. It may have to raise taxes or reduce social benefits, both of which can affect household budgets. Market volatility. Uncertainty around U.S. debt can cause large swings in stock and bond markets, impacting your 401, IRAs, and other investments. Reduced government spending on infrastructure and services. Less funding for roads, schools, hospitals, and research could indirectly hurt economic growth and job opportunities. The global consequences. U.S. debt as a world story. The U.S. national debt's implications extend far beyond America. The U.S. dollar's role as reserve currency means major central banks hold trillions in dollar-denominated assets. If confidence falters, these reserves may shift, disrupting currency markets and trade balances. Emerging markets rely heavily on dollar funding. Federal Reserve policy changes driven by U.S. debt concerns can cause sudden capital flows into or out of these markets, sparking instability. Global interest rates may climb, slowing economic growth worldwide. Financial interconnectedness means a U.S. debt crisis could trigger uncertainties similar to or greater than the 2008 financial crisis, jolting markets globally. Why hasn't Washington acted? Politicians face tough choices, cutting spending or raising taxes. Neither is popular. Gridlock persists, with lawmakers divided on how to reduce deficits or reform entitlement programs, despite clear warnings by the IMF and Congressional Budget Office. The U.S. could be running out of time. The Congressional Budget Office projects if no reforms occur, debt will continue climbing past 140% of GDP, exposed to shocks that could trigger a fiscal crisis worse than World War II-era challenges. What can you, the investor, do to protect yourself? In times of uncertainty, smart investors act strategically. Diversify. Avoid overdependence on U.S. dollars or government bonds. Consider gold, silver, real estate, foreign equities, and emerging digital assets. Manage personal debt. Lock in fixed interest rates on mortgages and loans. Pay off high-interest debt to reduce vulnerability to rate hikes. Inflation-protected investments. Treasury inflation-protected securities and real assets help preserve purchasing power. Maintain cash reserves. Cash readiness provides flexibility to seize opportunities in volatile markets. Stay educated. Follow reliable financial news, track debt developments, and adjust your portfolio proactively. Main Street to Wall Street. Your financial compass at Main Street to Wall Street. We break down complex financial topics into clear, actionable insights so you, investors, can plan and prosper. Subscribe and hit the bell to stay updated on vital economic stories that affect your money and future. Final thoughts. The U.S. national debt crisis is a real-world challenge with global and personal implications. The safe haven dollar faces unprecedented risks. But with knowledge and strategy, you can navigate uncertainty and protect your wealth. Thank you for watching, investors. If this video helped clarify the stakes, please like, share, and comment below with your thoughts and strategies. Stay smart, stay prepared, and see you next time on Main Street to Wall Street.